must-haves in your portfolio, and stocks of companies in developed markets. These are the stocks from the more mature economies outside the United States, like Europe, Japan, Canada, and Australia. Basically, the countries that have been around the block a few times and have the wrinkles to prove it. When it comes to foreign stocks, these are like the finely aged wines. Maybe not as thrilling as a tequila shot, but it won't leave you with a headache in the morning. The upside to international stocks is the lower risk you get when adding them to a portfolio of U.S. stocks. Yeah, the returns aren't as high as we'll see in the data, but spreading your risk out to the other countries' stocks has its benefits. When the US is having a bad hair day, maybe the European markets are looking pretty sharp. And if you don't think that analogy is apt, well, the US was working through whatever this is in the 80s, and the S&P only did about 12% a year. Europeans were rocking the punk look and a stock market pushing 16% a year. And if you're thinking the US national debt at $35 trillion is getting a wee bit out of control, then those foreign stocks are going to give you some currency safety as well. If the dollar does crash under the weight of that debt, shares of foreign companies will actually increase because their assets are in those foreign currencies. For the lower risk and developed country stocks compared to those emerging markets, you'd think you'd have to accept a lower return, but it's not the case. While foreign stocks also end up at the bottom of the chart in quite a few years, they have enough strong up years to produce a solid